Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, a bit of a rocky start for U.S. equities. It's been a mixed bag. You've had U.S. large cap growth stocks outperform small and mid caps, but overall growth is leading value. If you recall, this is a dramatic reversal from the drastic underperformance of growth stocks during the start of the bear market in 2022. With several banks closing during the month of March, interest rate expectations from investors is starting to lower. We are now expecting at least one interest rate cut by the Federal Reserve in 2023. And then finally, a lot of questions about how does now compare to the great financial crisis. Let's take a look at a couple statistics that compare and contrast the two time periods. So U.S. growth stocks are having a strong start to 2023. The S&P 500, first, if we take a look back to 2022, as far as where did we come from, obviously a very negative year with all asset classes between bonds and stocks, if you will, down in negative territory. First time since at least 1970 that we've had bonds and stocks down, typically a little bit more uncorrelated than that. But you can see growth was down 29%. Value held up much better, only down a little less than 8%. International outperformed U.S. during that time period. And you can see bonds obviously experienced a significant drawdown. Most of that was rate driven because we actually see high yields slightly outperform as credit spreads never significantly widened in a consistent pace during 2022. So far this year, we've seen a bit of a reversion, right? We've seen bonds become a bit of a safe haven. We've seen some money flow into that, especially during the month of March when there was a lot of fear around regional banks. Growth significantly, look, up 12% year to date, value essentially flat for the year. So we've seen some of that outperformance in 2022 given back with some money flowing back into growth stocks. Some of that relates to the change in interest rate expectations. One theme that's consistent, international, keep an eye on it, still outperforming year to date as well. Interest rates, I talked about that. We had several bank closures, Silvergate Cryptocurrency Bank from Southern California. You had the Northern California Bank, Silicon Valley Bank, go under in March as well. And then Signature Bank in New York. So we had three bank closures. We had Credit Suisse bought out by UBS in Switzerland. That was under a lot of pressure from some financial reporting issues. What does all that mean? Well, investors are now expecting the Fed to lower interest rates sometime in 2023. Take a look at the Fed fund futures implied rates. These are the expected Fed funds rates going all the way out to January 31st of 2024 over the next 8 to 8 months. If you look at interest rate expectations on March 8th versus March 28th, right? March 8th was right before some of these bank closures. You saw January expected to be 5.44%, right? The Fed was going to keep moving those interest rates higher. Investors now reacting, saying, hey, the economy is going to slow. We've already seen some cracks. It's going to slow, that the Fed's going to be forced to start lowering rates to provide some stimulus. I think this might be a little overblown to the downside, but I think we're going to find it somewhere in the middle here as the rest of the year unwinds. And so this is a complicated subject, and we'll dig into this more perhaps in the coming months, but 2023 is different than the great financial crisis. So far, take a look at the blue line are the total number of assets per year of bank closures. And you can see back in 2007, it reached close to 374 million. And if we look at 374 billion rather, and so far we've had 319 billion, right? Number of banks dramatically different. If we look during the early stages, we've had 2 closed so far versus 25 back then, and that peaked at 157 banks. So it was much more widespread. It was obviously more of a balance sheet issue where we saw leveraged mortgage real estate securities and mortgage-backed securities levered up by hedge funds that caused a lot of issues with balance sheets. So far, this has been more of a liquidity crisis that the Fed's trying to solve for, and we've only seen it in pockets of cryptocurrency and venture capital-related issues right now. So very different thus far, something to keep an eye on. So finally, before we wrap it up, Easter's coming up. but not without a little scandal over across the pond. If we look at England, a gentleman was arrested in England after allegedly trying to steal a truck containing 200,000 Cadbury cream eggs. All right. My son likes those, but not that much. All right. And so we'll see what he faces. I don't know what he was planning to do with the 200,000 Cadbury cream eggs. I don't know if there's a big resale market or not, but he might be in a little bit of trouble. We'll have to see and keep an eye on what his sentence looks like. With that, I want to thank everyone for watching, and we'll see you next time.